Welcome back to Canada Accounting Insights. Today, we're diving into a critical area that affects every single audit: fraud of financial statements. By the end of this video, you will understand about types of fraud, the fraud triangle, auditor's responsibility related to fraud as per CAS 240, and more. Before we jump in, don't forget to like this video and subscribe to the channel. It really helps us grow and continue bringing high-quality CPA content straight to you. All right, let's start with the foundation. In an audit, the risk of material misstatement can come from two sources. 1, error, which is unintentional, and 2, fraud, which is intentional. Fraud is trickier because it involves deliberate actions to hide or manipulate information. And even though fraud is always the responsibility of management, auditors are required to perform procedures to identify and assess risks of material misstatement due to fraud. The three main players involved in fraud could be management, employees, third parties. And the two major categories of fraud you need to remember are fraudulent financial reporting and misappropriation of assets. Let's break those down. First, fraudulent financial reporting. This is when management manipulates the financial statements, maybe to meet earnings targets, secure financing, or influence bonuses. Examples include overstating revenue, understanding expenses, manipulating estimates, improper capitalization, incorrect valuation of assets. Second, misappropriation of assets. This is usually committed by employees, not always management, and includes theft, skimming cash, payroll fraud, falsifying expense claims, or stealing inventory. The key difference? Fraudulent financial reporting affects the financial statements directly. Misappropriation of assets might or might not hit the financial statements, but when it does, it's usually through concealment. Now let's talk about one of the most important concepts: the fraud triangle. Fraud happens when three elements come together: pressure, often financial pressures, debt, unrealistic targets; opportunity, weak controls, override of controls, access to assets; rationalization, the mindset that I deserve this or I'll pay it back later. If even one of these is missing, fraud becomes less likely. But when all three are present, the risk increases dramatically. Now, what is the auditor responsible for? Auditors are responsible for obtaining reasonable assurance that the financial statements are free from material misstatement, whether caused by error or fraud. CAS 240 provides the auditor with guidance on identifying and assessing RMM due to fraud at both the OFSL and the assertion level. But here's the key: auditors are not guarantors of fraud detection. Still, the standards require us to maintain professional skepticism, consider the risk of management override, perform fraud-specific procedures, ask management and those charged with governance about fraud risks, evaluate unusual or unexpected relationships, assess the risk of material misstatement due to fraud at both the financial statement level and assertion level. And yes, management override of controls must always be considered a significant risk. Fraud risk is not random. There are patterns auditors look for. Factors that increase fraud risk include significant pressure on management, complex transactions, related party transactions, weak internal controls, aggressive earnings targets, high turnover in key roles, poor governance, significant estimates or subjectivity. Throughout this lesson, we'll see how each of these shows up in real audit scenarios. Next, let's talk about related party transactions, also known as RPTs. RPTs are transactions between the company and individuals or entities with a special relationship, like shareholders, directors, family members, subsidiaries, or companies controlled by management. Why do auditors care so much about RPTs? Because they can be used to manipulate earnings, shift profits, hide liabilities, move cash outside the business, inflate revenue, facilitate fraud. CAS 550 related parties focuses on the risk of material misstatement in the financial statements from RPTs and how to design audit procedures in response to these risks. Your job as an auditor is to identify all related parties, understand the nature of the relationship, assess the business purpose of the transaction, ensure disclosures are complete, evaluate whether the transactions occurred at arm's length. Unlike normal transactions, RPTs come with an inherent risk of misstatement simply because of the relationship involved. One of the biggest areas where fraud shows up is accounting estimates. Management makes estimates for allowance for doubtful accounts, warranty liabilities, useful lives, inventory obsolescence, fair value, impairment. Because these rely on judgment, they're vulnerable to bias, intentional or unintentional. CAS 540, Auditing Accounting Estimates and Related Disclosures, provides guidance on the auditor's responsibilities relating to accounting estimates and related disclosures in an audit of financial statements. Auditors must challenge management assumptions, develop independent expectations, review subsequent events, look for evidence of bias, evaluate the method used, confirm consistency year over year. If estimates are manipulated, the financial statements can be materially misstated without leaving obvious traces. Next up, contingent liabilities. These arise from past events but depend on future outcomes. Examples include lawsuits, tax reassessments, environmental penalties, guarantees, because they rely heavily on management's assessment and sometimes legal opinions. They're another area where fraud risk increases. Auditors must evaluate whether the contingency is probable, possible, or remote, whether amounts are estimable, whether disclosures are appropriate, whether management is being overly optimistic or hiding exposure. Let's go through the full scenario involving Summit Tools Incorporated. Summit sells tools and industrial equipment. Throughout the audit, several fraud risk indicators appear: pressure to meet loan covenants, unexpected gross margin changes, management override of controls, related party transactions with a company owned by the CEO's brother, large manual journal entries at year-end, an aggressive warranty accrual, missing supporting documentation for cash disbursements. As auditors, we evaluate each of these red flags. Is revenue overstated? Are expenses understated? Is inventory correctly valued? Are RPTs properly disclosed? Is the warranty provision reasonable? Are manual journal entries legitimate? Has management overridden controls? The solution involves assessing risk at the financial statement level and at the assertion level, identifying specific fraud risks, and tailoring audit procedures accordingly. Before we wrap up, here are the key points you need to remember. Fraud is intentional and always involves pressure, opportunity, and rationalization. Auditors must maintain professional skepticism throughout the entire audit. Management override is always a significant risk. Related party transactions are inherently risky. Always dig deeper. Estimates and contingencies require strong professional judgment. Fraud can come from management, employees, or third parties. Your role is to obtain reasonable assurance, not guarantee fraud detection, but to assess and address fraud risks properly. Always understand why a transaction exists, not just what it is. If you found this breakdown helpful, make sure to like the video, subscribe to the channel, and share it with other CPA students. And if you want more exam-oriented videos like this, from fraud to taxation to financial reporting, let me know in the comments. Thanks for watching Canada Accounting Insights, and I'll see you in the next lesson.